Everybody, and happy Tuesday. Appreciate you taking time today to hear about the big, beautiful act now. Took a while to get through Congress, but it is officially law. And we're fortunate today to have our member company, CLA, especially Alan Sobel and his colleague, D. Estep, going to walk us through some of the provisions, things that we need to know. So I want to thank also their colleague, Colleen, for bringing this to our attention, because this is such a hot topic, very timely. And so we're looking forward to the presentation. So with that, Alan and Dee, I'll turn it over to you. Thank you.
Great, thanks, Tony. Let me start out by showing my appreciation to the Commerce and Industry Association of New Jersey. You guys do an amazing job for businesses in the state, and we're just proud to be members and excited to be able to present the OBBA, the One Big Beautiful Act, to each and every one of you. Tony referenced that this was an act that moved fairly quickly. At times it may have seemed like very slow, but it is a huge bill, not only on the tax side, but on the spending side. And today, Dee and I are going to kind of walk you through mainly the business provisions, since this is a business organization, but some of that cascades into the individual side as well, and may be of interest to all of you. So with that, just one caveat, which is that while Dee and I are here as representatives of CLA, Clifton Larson Allen, any of our commentary or opinions here are our own. They don't represent opinions of the organization, and we appreciate, as I said, the ability to express those opinions here. So with that, we're going to cover the overview of the OBBA. We're going to talk about the business provisions, the individual provisions, and hopefully touch on many planning opportunities for each and every one of you as either advisors or owners of businesses in their own right. We're going to, kind of identify those items in the TCJA, I should say, the Tax Cut and Jobs Act, which was enacted in 2017, and those that were extended and how they might impact your planning. We'll talk about the changes in the SALT deduction, which may be of interest to all of us in New Jersey, one of the higher tax states, if not the highest. Discuss the considerations for right entity structure in light of some of the changes in not only the corporate tax rate, but some of the other advantages with regard to some tax provisions that are beneficial to other types of entities. We'll look at some of the accounting methods. We'll spend a fair amount of time talking about the bonus depreciation and the opportunities around how to get immediate expensing of capital expenditures. We'll touch on the energy credits and some of the things that are going to be impacted in this bill by that. And then as employers, some of the responsibilities you'll have with regard to how to report overtime and tip. As we've all heard, the notion of no tax on tips and no tax on overtime. It's not exactly true, but there are some benefits in here for those areas. And as employers, we'll have some responsibilities to report that. So with that, I'm going to turn it over to Dee, who will take us home from there.
Perfect. Thanks, Alan. Good morning, everybody. I'm super excited to be here and share some thrilling tax topics. Alan and I, obviously, we're CPAs, and we might geek out on some of the tax legislations when they come out. And as we've talked about, there's been lots of changes. Some of this moves slowly. There's been lots of different bills. So we as practitioners have had to look at all the different versions, see how it was going to impact our client base, and look at what's going on with the act, with the ramifications for small businesses and their owners. And so we're going to walk through what we see as the key tax law changes and give you a few planning tips today. Okay, let's start with compensation and benefits provisions. Some of the things we'll talk about today maybe don't directly affect your business or the business itself, but it will for sure impact the individuals that own the businesses in a pass-through entity structure. So some of the things we'll talk through, again, might not have a direct reporting requirement, but could be a benefit or a tax planning opportunity for the owners of the businesses. So this first thing here, 1099 reporting threshold has historically been $600, and that is being increased to $2,000. So I think that is a good thing. A lot of people over time have thought that $600 threshold has been very low, so that will be increasing to $2,000. There are new deductions that are allowed for qualifying tips and overtime payments. A couple of things here. This has kind of been heralded as a no tax on overtime or no tax on tips. The reality of how the mechanism for how this is working is that it is an above the line deduction that was enacted for overtime pay during tax years of up to $12,500, and then $25,000 if you're married filing jointly. This deduction that basically makes a portion or potentially all of tips or overtime to be tax-free, it does phase out. So if you're single, it phases out at $150,000, or if you're married filing jointly, it phases out at $300,000. So to deduct this overtime, married individuals, just want a quick note here, you do have to file a joint return, and you must include your Social Security number on your return. So although these provisions, again, appear to maybe have very limited impact on an employer because these are individual deductions, the main impact to the employer side is that you will be required to report the total amount of qualified overtime compensation on information reporting. It should be probably on W-2 reporting. Because this provision is retroactive to the beginning of 2025, I just want everyone to be prepared for this first year of reporting. It could be difficult, right? There is a transition rule that allows some leeway in year one. And do we have all the details on this? No, we don't at this point. So a lot of the things we'll talk about today, we'll tell you what it is that is going on, what the general rules are, but we're waiting for guidance, right? As with any, legislation that passes in Washington, we have to wait for guidance from the IRS as to how it's going to be administered, how it's going to be reported. And we don't have all the details on this one, but I did want to make sure everyone is clear that you will have a reporting requirement in some way to report how much of an individual's earnings fall under this potential deduction on the individual tax return.
And Dee, if I can just interject here, something to be cautious about, especially if you're working in the HR role. Many of your employees may come to you and say, wait a second, I thought that I wasn't being taxed on my tips, or I wasn't being taxed on my overtime. This is a deduction, as Dee pointed out. So this is actually they're going to get this benefit when they file their income tax return. It will reduce their taxable income, therefore increase their refund and or reduce the amount that they owe. They will not necessarily see it in their paycheck unless they have the ability to go ahead and change their withholding amounts, which I would caution against because they could get surprised at the end.
Absolutely. One related thing to what Alan just said is that this doesn't change FICA taxation of overtime. So it doesn't provide payroll tax savings. It's just a deduction at the individual level. From an employer standpoint, you would still tax it as regular wages. Social Security and Medicare taxes would apply on this. And this provision does expire right now on December 31st, 2028. Okay. The next, I think, important topic, and I think one of the most important topics from a business standpoint is the 174 changes. This is one of the areas that we're spending the most time right now with clients because it was a significant impact to a lot of our clients. As everyone probably recalls, the Section 174 required research and experimental expenses to be capitalized. Over 5 years, we had to kind of do little mini studies for a lot of our clients to make sure we're capturing all these expenses. You had to capitalize it. You couldn't deduct it in the year that you paid for it. So OBBBA reinstates the ability to expense these expenditures for tax years beginning after December 31st, 2024. So this is a very welcome development for businesses, especially those that invest heavily in innovation. Especially those in like the design build space, a lot of our manufacturing clients, this is really affecting. So just something that you got to really dig into the details of this particular provisions of the act. Similar with the overtime in tips provisions, do we have all the details of how this is going to work? We don't, right? But we know the basics. Right now, our thought is that unamortized 2022 through 2024 Section 174 expenditures can be deducted in 2025 or ratably in 25 and 26. Small business taxpayers, those with average annual gross receipts of less than 31 million, so same rules as like, the other small business provisions, those that qualify as a small business taxpayer, you can actually choose to file amended returns and deduct 22 through 24 domestic R&E expenditures. So I want to make sure that, again, the change did not affect foreign R&E expenditures. You would still have to capitalize those.
Dee, do you mind, Dee? I'm sorry. We have a question from Lucy.
And I wanted to make sure, do you want me to hold my question or ask it now?
Oh, you can ask it. Sure.
Okay. So our firm is in the service business, and our equivalent of R&D would be anything that is related to a design system for, internal clients that we support around culture assessments, or R&D related to learning content creation and design of that. Would that be included, or is this provision strictly technology specific R&D? Does it also include knowledge capital and knowledge workers?
It's not specific to technology. It's not specific to a particular product or type. If you have what the IRS deems as these research and experimental expenditures, there's some very specific requirements that fall under that bucket, and it can 100% can be intellectual capital or something that's not specifically like technology. It's not. We have construction contractors that there's 174 expenses in. Obviously, manufacturers. Certainly, some service businesses, other service businesses. There are some expenses that are in there.
Got it. And it goes back. I think I heard you say retroactively to 2022.
22. Yep.
Got it. Okay. Thank
But
you.
Lucy, if I can just clarify that. So, what happened under the Tax Cut and Jobs Act is that if you had R&D expenditures, they had to be capitalized and written off over a 5-year period. So the idea of going back would be in those situations where you have capitalized the research and development, potentially taking R&D credits, and then going back and somehow recovering that either this year or ratably or amending the returns. You could go back in time and do what they call an R&D study, a research and development study, to see if your expenditures do in fact qualify for credits. But if you've already expensed it, there's not a whole lot of benefit right now in this.
And that I'm aware we haven't. And so this is sort of new news to me, because much of what we do is, in the development space, and it is directly linked to intellectual capital and intellectual property for the firm. So that's an item that is welcoming news. Thank you.
Yeah. As Alan said, letter of the law going back to 22 is that if you had these expenses that were categorized as R&E expenditures under the IRS rules, you're required to capitalize it. What this new bill allows for is that you can potentially go back if you're a small business taxpayer and amend those tax returns. Right now, our thought is that it's all or nothing, right? You can't just go back and amend 24. We're having a lot of conversations right now. If you haven't filed your 24 tax return, can we go ahead and deduct it and then not go back to 22 and 23? Lots of nuances to these rules. I think right now our general thought is that we have to still capitalize it for 24 if we're not planning on going back, and especially if we're not planning on going back and amending 22 and 23. There's lots of issues here, especially if you're a partnership and there's under the BBA rules, lots of nuances, right? Because especially if you're a large partnership, it's very difficult to do an AAR, and you would potentially have to go back to 2022 and do those amendments. And so just wanted to note it here that we don't have all the answers, but there can be significant opportunities to potentially go back and amend these tax returns and deduct those in full. A couple of just quick notes here before we move on. The bill does retain that 15-year amortization period for foreign research and experimental expenditures. It adds the option to amortize domestic expenditures over a period of not less than 60 months if you're not currently expensing them. So just a few notes there. Okay, so the planning opportunity here really a takeaway, make sure you're examining your research and development costs. If you're required to have previously, capitalize them, and you did, a small business, taxpayer, obviously go back and look and see what you can potentially deduct on prior, or adjust your 25 tax planning to potentially deduct and fully deduct what you've previously capitalized in the current year. As Alan mentioned, if you have not previously looked into your research and development expenses and you actually do have them, there are R&D credits available that you could potentially look into.
Indeed, just one other put an exclamation point on this. Contrary to what people may perceive, New Jersey is actually a very, very robust research development state. We do a lot of manufacturing in the state, and there are a lot of opportunities. And just to kind of highlight it, if you had $500,000 of research and development in 2020 and had to capitalize that, that probably cost you about $120,000 more in tax. So take 2020, 21, 22, you start adding it up, it's a lot. If you then reverse it, have the ability to reverse in this year, it could result in significant tax savings for the 2025 and 2026 going forward years.
Yeah, 100%. Okay, bonus depreciation. Very excited. I do a lot of work in the real estate space, and this is welcome news that the changes in bonus depreciation, they have the OBBBA permanently extended 100% expensing. The key thing here I want to make sure and highlight for everybody is there's two pieces to what, your ability to expense 100%. The property has to be acquired and placed in service after this January 19th date. So if you have a contract and you acquired it, but didn't place it in service until, like, say, second quarter of 2025, if that original contract and purchase was prior to January 19th, unfortunately, it would default to the pre, OBBA rules under the TCJA. So that's a key distinction. So it's something to just keep in mind, that you have to make sure that you're being very mindful of when you purchase it, when you're placing it in service, as to which rules it applies to. There are new rules for qualified production property. This is very exciting. This was an attempt to bring back manufacturing facilities and production facilities to the U.S. So this is 100% expensing for qualified production non-residential real property, which historically obviously have much longer lives, but this production property could be 100%, but you could take 100% bonus. On this, what we're calling QPP, this qualified production property, a few notes here. It applies to property used for manufacturing and production facilities. The construction has to begin after January 19th, 2025. So again, if you started construction last year, but you haven't placed it in service, that doesn't qualify based on what we understand right now. And it has to be placed in service before January 1st, 2031. So construction begins between January 19th, 25 and before January 1st, 2029. That's when construction has to start. And it has to be placed in service before January 1st, 2031. So longer timetable on this one, but just want to make sure that everyone is clear on the rules there.
So when we're dealing with a typical building, oftentimes we recommend doing cost segregation studies, which will allocate a portion of the property to property and equipment, which would then qualify, or leasehold improvements, which would then qualify for the bonus depreciation. In this manufacturing world, this qualified production property, if I'm understanding this correctly, you can write off the entire cost of the building in the year that you place it in service, so long as you meet those requirements of having been acquired and or placed in service after the inauguration date.
Yeah, that's correct. Again, we don't have all the regulations yet, all the rules, but our understanding right now is if you fall under these parameters, 100% of that, what we would normally capitalize as a building, right? Those costs, that production property would be available for the 100% expensing based on what we understand at this point. Yeah.
I mean, if you think about that, that's huge, right? I mean, you could be $20 million for a manufacturing facility and you're writing it off all in year one.
Yep.
So,
Big opportunity here. Yeah.
We have a question in the chat from Lucy. What is the definition of property? Is it only real estate, or does it extend to other purchases like autos and equipment?
Yeah, so all the other property that we historically, automobiles, equipment, all of those would fall under the normal 100% expensing rules, right? So you would be able to take 100% depreciation on those types of assets anyways. This qualified production property is real property. Based on what we understand, it just opens up that 100% expensing to the real property asset related to production in manufacturing. Yeah. Great question. So the planning opportunity here is a lot what Alan talked about is looking at the opportunity for these production and manufacturing facilities, but also any other real property assets. You could potentially do cost segregation studies for purchases, for contracting and purchasing in 2025. As it relates to new real estate, assets, we can do a cost segregation, bifurcate the asset, and take 100% bonus depreciation on anything that we can segregate into those lower class lives. And then obviously looking at the opportunities for production and manufacturing facilities. Okay, a few notes here on clean energy tax credits. What OBBBA addressed is it basically accelerated the phase out for these energy tax credits. There were certain IRA incentives, items like Section 179D deductions and Section 45L credits that will sunset for new projects starting after June 30th, 2026. So just make sure that you're reviewing your timelines, consider fast tracking eligible improvements if you are planning on taking the 179D deductions or 45L credits. One thing that we try to do with 179D is kind of bundle that with the cost segregation, because a lot of that work is similar. So if you're taking 179D, those are going to be sunsetting starting for June 30th. The Section 179D is currently available to owners who design energy efficient commercial buildings. Certain tax exempt owners can allocate those deductions to qualifying designers involved in that project. So what this bill does is it repeals this deduction with respect to that property for the construction, which begins after June 30th, 2026. So you've got to have construction start prior to that date if you were planning on using that. Early termination and accelerated phase outs for some other credits that are EV related and solar and wind credits. Lots of details here as it relates to the credit. So if you were in the process of either selling or buying or looking into these energy tax credits, a lot of the rules have changed, and there's a lot of early termination and accelerated phase outs for these credits.
And Dee, if I can just because these numbers and code sections can get confusing for everybody, and they all interact with each other here. So 179D, for example, we talked about a cost segregation where you take a portion of the building and you allocate it to property and equipment, or qualified leasehold improvements, and you get to write that off currently now at 100%. Prior to this law, it would have been 40% for this year. What 179D does is it takes a certain dollar amount, depending upon the energy efficient inputs that you put in place. It takes a certain dollar amount per square foot and allows you to take a portion of the remaining building and write that off as a 179D deduction. So again, these all kind of come into play together in a method to be able to accelerate it. And I think the big takeaway here, while this is not a change in law, the big takeaway here is the ability to make sure you take advantages before it expires in June of 2026. So there is a window here to accelerate some of your expenditures to get started if you can see a benefit to this 179D.
And this slide just kind of big picture what these energy provision changes are. The 179D that Alan just mentioned that is repealed for projects after that 6/30 date. 45L, a lot of our home builders have taken advantage of that. That was changing anyways. We were, the rules changed, got more strict on who could take those, but they are repealing those for homes acquired after that 6/30 date. And then as Alan, and I talked about, just make sure you're planning ahead for any of these energy credits that if you were planning on taking them out, just because they were significantly changed. Okay, just real quickly here, 163J is a business interest deduction, and there was relief for returns for 2025. As most people probably know, a couple of years ago, they changed the formula for the limitation for 163J that increased taxable income for a lot of taxpayers. So you could benefit from these increased interest expense deductions as the depreciation and amortization will once again be eligible to be added back when calculating that limitation. So lots of details here. We won't go into the actual calculations, but just be mindful if you were limited from 163J because you have high interest expense on tax returns. This does reverse that restriction that started in 2022 and could improve cash flow planning if you have highly leveraged projects or businesses. And so just big picture, again, 163J is generally limiting interest expense to 30% of adjusted taxable income. Back in 22, that depreciation, amortization, and depletion were not added back to get to this adjusted taxable income. So this calculation change had a lot of impacts on more capital intensive businesses, including many construction contractors. And so I just wanted to mention that here that you can have some better cash flow on those highly leveraged entities.
I think this is one provision that caught a lot of people off guard, to your point, where you had a highly leveraged business and you weren't able to deduct your interest on your loans, whether it's working capital or term loans or whatever the case may be.
Yep. So the planning opportunity here is just making sure that if you have, high interest expense in your business, to make sure that you're managing those interest deductions, and you might need to adjust your 2025 tax planning to account for these changes in the limitations, because you could have improved cash flow related to that increased interest expense on your returns.
Just a clarifying point, this is not retroactive as the R&D credit, is that correct?
That's correct. Yeah, that's a change. Yeah. But good question.
And one other thing, Dee, there were some workarounds, and I don't want to get too into the weeds on this, but there were some workarounds on the interest deduction by electing out of, accelerated depreciation methods. For those that made that election, that's a permanent election as far as I understand, unless there's some change there. Yeah. So some of the workarounds that were done may actually come back now with this change and hurt you a little bit. So unfortunately, you're sort of stuck with that.
Mm-hmm. Yeah, and it's not a bright line thing where it's like, okay, this is beneficial to you, right? You got to obviously analyze, model based on each individual situation. Yep. QBI, this is another provision that we were very hopeful would stay in and get made permanent. I think all along we felt like this one was going to be in there. And thankfully it is. This is very good for the business community. It permanently sets that QBI deduction at 20%, and the phase out range increases. So I think this allows us to kind of solidify that long-term planning. If you operate through partnerships, LLCs, S corporations, and this could influence your decision as you move forward with tax planning. So a very positive piece of the bill that made QBI permanent. So,
and for those who are interested, it takes essentially the highest marginal tax rate of 37%, and because of this deduction here for qualified businesses, you'll get down to a effective tax rate or a tax rate of about 29.6%. So it brings you below 30% for those that qualify. Not all businesses qualify, Dee, right? I mean, professional service organizations generally don't, and that's where this phase out range comes into play.
Yep. Yeah. Not all businesses qualify. As Alan mentioned, like professional services, like CPA firms like ours, we don't qualify for it. So there are certainly limitations. This is not an across the board 20% deduction.
And out of curiosity, why is that? I'm also a professional services firm, so I'm just curious why industries or firms excluded?
I think the foundation of it, and this is just my personal opinion, is that professional services is looked at as the income is generated by personal services. which in the world of, subject to self-employment tax, it's effectively W-2 wages or pass-through income to individuals that are doing professional services. Other income that is generated from businesses that are not directly linked to personal services it seems to be, that's what a lot of people think, that's why there's a different carve out. Again, not 100% sure
Okay,
why.
got it. Thank you.
Maybe the CPA and professional service lobby wasn't as good. As good.
Down to lobbying, Lucy.
I know, no kidding.
Well, it is
We are
interesting.
earning revenue for the state, right?
Yeah.
It is
we
interesting.
we don't have a good lobby as CPAs.
Yeah.
As opposed to the engineers and the architects who seem to carve themselves out of that definition. So good for them. Kudos to them. It does still apply to professional service organizations when your income is below a certain threshold.
Right.
So don't rule it out completely. But if you are a higher income earner, you will not get the benefit of that 20% deduction.
Yeah. Perfect. A couple other quick notes here on other business provisions. There was some good changes to Section 1202. So if you're not aware of what 1202 is, it's a potential exclusion on the gain from the sale of small business stock. There are now some tiered gain exclusion percentages and some changes to the limits. So I think there's some significant opportunities to plan around if you're working to sell your business or you have a small business. That exclusion cap increased from 10 million to 15 million. It is inflation indexed. It is effective for stock issued or acquired on and taxable years beginning after the date of enactment. So it's if you start a business and you might want to be mindful of your entity type and do a lot of work with your advisors as to what the potentials are to potentially exclude a portion of the gain or potentially all of the gain if you were to sell your business. So we won't go into, again, lots of details we could talk about on this 1202, but just be mindful is that if you're in that situation, that there's some really great changes to the 1202 exclusions. And then one thing on new limits on the corporate charitable deductions. There's also a new limit at the individual level, but this one is charitable contributions would be deductible by a corporation only to the extent they exceed 1% of a taxable income floor and are less than 10% of a taxable income ceiling. And so they're putting a squeeze a little bit here. The individual floor is 0.5%, so a little bit different on the individual side. And Ellen will mention that here in a minute. Okay, that really the planning opportunity here is just making sure you're, evaluating and potentially reevaluating your choice of entity based on the tax legislation. Corporate tax, rates do remain low. There's expanded 1202 benefits on pass-through businesses with enterprise values under that $75 million threshold, which is the new threshold. Just making sure you're modeling whether converting to a C Corp could offer those long-term tax advantages, especially if you're considering a future sale or maybe outside investment is anticipated. Lots of really great things with 1202 right now with the new law. So just make sure you're having conversations about those strategic consultations, tax structuring, in different scenarios that you're analyzing those and making sure you're working with your advisors.
Dave, I just want to, this is one of the sort of provisions that a lot of people don't focus on. They historically, closely held businesses have been pass-through entities, and everybody thinks about the double taxation and why you don't want to be a corporation, right? Because you're going to get taxed at the entity level and then at the corporation level. But this provision is really powerful. And I'm just real quickly, we had a client who invested in a startup business, actually came to me the year before this took place and said, how do I take the loss on this thing? It's worthless. And I said, well, you have to sell the stock. And he said, well, I don't want to do that. Okay. Well, lo and behold, the following year they did a SPAC. They rolled into a SPAC. The stock went from like $1 to $30. He got out with about a $65 million gain. And between him and his two children, they were able to exclude $30 million of that gain from federal taxation. So think about that. That was a huge amount of tax savings. This opportunity, isn't going to apply necessarily to every business, but if it is if you have a business that you think you might want to sell in the next 3 to 5 years, this is a good thing to consider.
Yeah, definitely. Okay, I'm going to hand it over to Alan. He's going to talk through some of these exempt provisions.
Great. So basically, as we move along here, there are also some provisions in here about exempt organizations. Some of them are going to be applicable and some of them aren't necessarily going to be applicable. Whoops, sorry, I went too fast. I lost my screen here. Whoa, there we go. So first of all, excess compensation. I don't know how many nonprofit organizations are paying their executives greater than $1 million. But if they are, there is going to be an expansion of the excise tax on that income. It not only applies to the compensation, but also severance payments. So just something to be mindful of if you fall into that area. And then on the higher ed endowments, you've heard a lot about this probably in the press. There is this now 3-tier tax rate on higher ed endowments. Essentially, they look at how much endowment is in place per student, and depending upon the level of that, will increase the amount of the endowment. Harvard, for example, has been in the papers about this because I think it's going to increase their excise tax by several $billions, and will be. I don't want to say punitive, it may be the right word, not the right word, I don't know, but it's certainly going to be impactful for these organizations. None of this will really have an impact on small or mid-sized nonprofit organizations. It's really out to target the larger organizations that have accumulated significant amount of endowments.
Alan, do you think that'll hurt? I'm sorry, that'll hurt, I guess, of these higher ed foundations and people contributing to them, or?
I think at the very high end, I think it will. It may, every law seems to find workarounds. So I wouldn't be surprised if these organizations figure out a way somewhere along the line to mitigate some of the problems here. But, the large institutional universities, Princeton, Harvard, MIT has been talked about. I think they are going to get impacted by this increased excise tax. So yes, Tony, I think it will be impactful, but probably not so much on the smaller organizations where they don't have these. I think if I remember correctly, I think something like $2 million per student in endowment gets you into the maximum maximum excise. Right? Think about that. Right?
Yeah,
it's a big number. So.
Thank you.
Mm-hmm. Again, probably outside the scope of this short meeting, but there is some international provision. There's always this aim to avoid, to curb the tax avoidance for multinational corporations, and so all of these GILTI taxes, these B taxes, these foreign derived income tangible taxes, they're all going to remain within the bill itself. So if you have international partners or you're sending money overseas, be mindful of provisions that may be impacted as a result of this act.
One thing I'll note on the international provisions of something that got in the final bill got left out. There was lots of discussion about Section 899 that was in the bill as to the limitations and the kind of penalties on foreign investment. This was expected to have significant impact on real estate investments because there is a lot of foreign investment in the real estate developments. And so I think the real estate lobby, we're members of the organization called the Real Estate Roundtable and participate in meetings in DC as it relates to real estate provisions within tax legislation, and there was a lot of lobbying to remove that from the final bill. So I think there was a lot of positivity on the fact that Section 899 was removed and not in the final bill. So currently there is not any restrictions or penalties for foreign investors based on the bill. So I just want to mention that.
Awesome, thank you, Dee. So now let's talk a little bit about the individual laws. Actually, the individual taxation changes. So good news here. If you were paying attention at all, at the end of 2025, without this tax bill here, tax rates were going to go back to what they were pre-2017, which, ignoring the lower brackets, would have raised the highest marginal bracket for individuals from 37 to 39.6. This now has permanentized these brackets and has actually instituted inflation adjustments on the lower brackets as well. So that's a good provision that's here for taxpayers. Personal exemptions, if those of us who are old enough know that we used to take these personal exemptions, that's now been permanently repealed. There are no permanent personal exemptions anymore. The trade-off on that is a higher standard deduction. But in addition to that, they've permanentized the increase in the child tax credit to $2,200. That's also good for families that have children. A big trap for many in the past, a big trap for many people on taxes was the AMT, the alternative minimum tax. It typically would kick in for a number of provisions, but one was high state and local tax deductions. Another was stock options and the exercise of stock options. With a higher exemption now and phase out, where their thresholds are being in place, the AMT does not impact nearly as many people as it once did. But so this has become a permanent provision of increasing the higher exemption amount. And then I'm not going to spend any much time on this, but the premium tax credit for those that are in low income areas that are getting assistance with the Affordable Care Act. They've kind of capped some of these things for low income earners. The idea is to try to not give benefits to people that are sort of not out there working, that are capable of working, or that are not participating in the economy in the way that they should, whether it's I'll leave it at that, in different ways.
Alan, I just want to comment, because I'm hearing in at least 3 places where very specific changes are impacting either foundations, lower income, and or organizations that have funding available to address sort of this gap in need and opportunity. Am I reading that the right way, or hearing that the right way?
I think so. I mean, I don't know that it's an attack necessarily. Well,
oh no, I didn't use the word attack. I'm sorry.
No, I'm using that. That's my term.
Okay.
I'm not sure it's like an attack on these things, but it definitely a tightening up of some of these, these provisions in the low end of the income spectrum where there is this notion that people are taking advantage of the systems and things like that. And then on the higher ed side of it, I think it's just a political element of, you have all this money, you should be paying some tax on that, even though you're using those for tax exempt purposes.
Got it.
I mean, no big surprise that a budget and a tax act would have some political elements to it.
Oh, yeah, no kidding. Yeah. Thank you.
I mentioned the standard deduction is made permanent. It is going higher to, I believe it's $30,000 now for a married couple. So that eliminates the need for a lot of people to itemize their deductions, which simplifies the tax act for many of them. But on the other hand, it does have other effects, like things, for example, like charitable contributions may not benefit you in the way that it did if you were an itemizer. And so it may have an impact of reducing contributions. Hopefully not. People hopefully give because they want to do right, for the community and for their own personal values. But nonetheless, some are motivated by those. But the standard deduction is going up. There was something called the P's limitation. So when you had an itemized deduction, when you itemized your deductions, and that is when you got over the standard deduction between state and local taxes, mortgage interest, and charitable contributions, probably being the big 3, maybe investment interest being the 4th, there was a limit on how much you could deduct based upon your adjusted gross income. They now have repealed that, what they call the P's limitation, that's PASE limitation, and they've replaced it with this other mechanism, which will still have an impact, but it only will apply to those in the highest marginal tax bracket. So those earners that are below $626,000 for a single taxpayer, $752,000 for a married couple filing jointly, you will not have a limitation on your itemized deductions, and that's a good thing. Sometimes this PEAS limitation hurt, again, some people that are middle class taxpayers. Miscellaneous deductions are permanently suspended. What are minimum miscellaneous deductions? They vary. It could be everything from union dues to investment advisory fees on your stock portfolio. Those were not deductible under the Tax Cut and Jobs Act, and now they're permanently suspended in that regard. A lot of attention is given to the state and local tax limit. As you are probably aware, it was limited to $10,000. That has now increased to $40,000 for a married couple. It does phase out, however, or phase down back down to $2,000 when your income exceeds $600,000. So if you are a high earner, you will be limited on your SALT deduction to $10,000. But if you're anywhere between $500,000 and $600,000, that number will phase out. If you're below that number, you'll get the full $40,000 deduction. And then the other thing that you may have heard about is this no tax on Social Security. That's not exactly true. What is put in place instead is a deduction for seniors 65 years and older. This will run for 2025 to 2028. And if your income is under $75,000 for a single and $150,000 for a couple, then you'll be able to take this deduction. Above those amounts, you'll lose that deduction. I should mention the SALT is in place between 2025 and 2029, and then that too will be go back to the $10,000. A lot of these phase outs and a lot of these things are triggered towards the way they score these acts. And that's what happened in 2017 and why this bill has put some things permanently in place so that we don't have to have the uncertainty as to what's going to happen year to year.
One thing I'll mention there, Alan, on that, just as an aside on the SALT deduction, in the various versions of the bills, prior to the final passing, there was a lot of items that were in there that were potentially going to limit, the pass-through entity tax regimes that the states put together across the country, limiting the potential deductions on the business entities if you paid these PTEs. There was lots of discussion, lots of items that were in some of the original versions of the bills. The final versions of the bills, those were not in there. So I think that was met again with a lot of positivity that didn't stay in there in the final versions. It did preserve the ability to make those elections and preserve the ability to deduct those on the business side. So just a planning opportunity there is that if you haven't evaluated the pass-through entity tax regimes in the various states, especially if you're working in a multi-state environment, that you're being mindful of that.
Yeah, and that's a huge deduction available for pass-through owners that would have been hurt by this limitation significantly. So that's a great point, Dee. Yeah. Moving along to charitable deduction provisions. So on the good news side, if you don't itemize your deductions, if you are using the standard deduction, there is now a provision to allow you to deduct $1,000 for a single, $2,000 for a married joint without itemizing. So if you make charitable contributions of $1,000 or more as a single or $2,000 or more as a married joint, you will get a deduction for that in addition to your standard deduction. That's really positive. For those that do itemize, there is this new floor on charitable contributions equal to 0.5% of your AGI. So basically, if you make let's just say $500,000, $2,500 of the first $2,500 of your charitable contributions will not be deductible. So it's a way of limiting it to a certain degree. To Lucy's point, I don't know whether this is designed to somehow limit contributions that are being made. I think there's some abuse that takes place in charitable contributions. I think people oftentimes will say, you know, oh, well, I gave to this without necessarily having the proper documentation and playing a little bit of the audit game. It takes a little bit of that low-hanging fruit off the table in some respect, because you don't get the first 0.5%. But those that give a lot will not have a big impact as a result of this, unless they make, you know, tens of millions of dollars, of course. So here's another good thing. A lot of scrambling. The estate planning attorneys were scrambling in the last couple of years to do gift and estate planning, because the lifetime exclusion was scheduled to be reduced back to the 2007 levels, 2008 levels, which were about $6 million. They were around $14 million last year, or meaning this year, 2025. Now they've been raised to $15 million. That's been permanently increased to that dollar amount. That's per individual. So that's $30 million for a married couple. And they will continue to be indexed for inflation. So I would say mid-sized large estates will not be subject to estate tax, which is probably a good thing for, you know, again, the business community and people that own real estate and the like. And, you know, you have a home and things of that nature. Things add up pretty quickly in terms of value. And now you won't have to be too concerned about the estate being hit with the estate tax. Couple that with New Jersey doesn't have a inheritance, or I'm sorry, doesn't have an estate tax. That's also a positive thing. So, you know, states can transfer, you know, estate tax free here in the state. There was some talk about possibly increasing, you know, not allowing a stepped up basis, meaning that if you don't pay estate tax, you don't get to adjust the fair market value to the fair market value of your basis of your assets. That is not part of the bill. So that's a good thing for taxpayers. The other thing you might have heard a lot about are these Trump accounts. This is that essentially the ability for parents to save $5,000 a year for their children up to the age of 18 and accumulate those on a tax deferred basis. I say tax deferred because eventually when you pull that money out, it will be subject to tax. In addition to which the government, I should say, is going to deposit $1,000 for any child born between the date of 1/1/25 and 12/31/28 into one of these accounts. These accounts do require you to invest them into low-cost index funds. And as I said, they do grow tax deferred. Somebody ran the numbers on this, and if you put in $5,000 a year for a child until they're age 18, and they don't touch it until they're age 65, they will, and let's just using a 4% interest rate, they'll accumulate over $850,000 by the time they turn 65 years old. Now, inflation might eat into a lot of what the buying power of that is, but that's a pretty remarkable illustration of how compounding can be real valuable here. If it is pulled out, it is subject to tax. If it's pulled out for what they call exempt purposes, which is education and the purchase of a home, it is a more favorable tax rate. If you just pull it out for your own, you know, just for purposes of general spending, it's going to be subject to ordinary tax. And there, while it's not definitive yet, it appears that there might be a penalty, a 10% penalty, if that money gets pulled out before the age of 59. You can't pull the money out before the age of 18. Let's see. So, you know, some of the things that you might want to consider. Let me just talking about those Trump things. A lot of people might be thinking in terms of, am I better off doing a 529 plan, or am I better off doing one of these Trump savings accounts? You know, I think you have to weigh that. That is a planning different situation. But if you use a 529 for education, it is not subject to tax. And so in that regard, I think it is a more favorable than these Trump accounts, which will be subject to some level of tax when the money is pulled out. What you want to do on the planning side is to effectively manage your itemized deductions. You can bundle things. So if you are a taxpayer who is on the edge, maybe defer some of your charitable contributions to the following year, bundle them together in the second year so that you get the full benefit of the standard deduction in year one, and then you get the full benefit of your itemized deductions in year two. You have less control over how you pay interest on mortgage. So I don't think you have a lot of planning in that regard. And then you do have some ability on the state and local taxes to bundle them together, depending upon when you pay your estimates or when you pay your real estate taxes. But again, that's probably not a lot of play in there, because I think the town would be all over if you didn't pay your real estate taxes. And certainly the government's going to penalize you if you don't pay your income taxes on time. All right. Oops. Yeah. So opportunity zones. This is really a good opportunity for people that like to invest in real estate and are looking for ways to defer capital gains. Many of us are familiar with Section 1031, which is the ability to take the proceeds of the sale and roll it into another property and defer the gain on that until ultimately you don't do a 1031. Well, opportunity zones essentially provide a similar benefit, but with a lot more restrictions. First of all, you must hold the property for more than 5 years in order to gain the reduction of the gain reduction. The second thing is you must realize the gain on the 5th anniversary of the investment. So before there was a date certain under the current law. After a certain date, you had to recognize the gain. Now it's a rolling 5-year period after you make the secondary investment. But essentially what this does is it allows you to take the gain on the sale of property, reinvest it into an opportunity zone, defer the gain for 5 years, and then the appreciation on that subsequent investment is essentially tax-free when you ultimately sell that. It has to, in order to qualify, it has to be a designated opportunity zone area. This is something that does get quite complex. So again, I strongly encourage you, amongst all these things, talk to your tax advisors along the way. I think the takeaway here is if you're looking for deferral opportunities because you sold a piece of property and you're looking to defer the gain in a way that will also allow you to invest in opportunity zones, this is a good provision that's out there. So again, summary of some of the planning opportunities, itemize deductions, manage them. Let's make sure you take a look at the business deductions and the impact on you. One of the business things that we didn't talk about, we talked about all this bonus depreciation, and we talked about all these, the ability to write off R&D expenditures. Well, it may actually result in losses at the business level. You may aggregate some of your investment properties and your business, and you might wind up in the loss. Well, there is a limit on how much you can deduct. You can use that loss to offset other income like wages and portfolio income, interest, dividends, and capital gains. That limit is $500,000. So take all of your losses, aggregate them together against your investment income. I'm sorry, your business income. The amount that exceeds $500,000 can be used to offset wages and portfolio income. Anything in excess of that becomes a net operating loss and is available in subsequent years, subject to some limitations. That was also a change that they were looking to make within this bill. And fortunately, the new bill the final bill that came out does not put that limitation in place. So if you think that you're a high wage earner and that you got all these losses to offset your income, you will have some limitations on there as you manage those business deductions. So you can see this gets kind of complex as you go through the planning process. Business interest deduction, something to manage. Cost segregations are a great planning tool to allow you to take advantage of the better depreciation and the 179D deductions. We talked about 1202 and the choice of entity, and the ability to potentially exclude gains from the sale of a business, or at least the stock sale of that business. The energy credits are changing, they're expiring. Now's the time to jump on them if you're going to take advantage of them. And if you're an exempt entity, just start preparing for the changes that are in place. I think that we covered pretty much everything.
Yeah, we're at 9:02, so I want to be mindful of everyone's time and respectful of everyone's time. But hopefully this gave everyone an overview of the bill.
By the way, Dee's in Texas. That's why it's 9:02 where she is. We're 10:02 here in Jersey.
I didn't realize that. She's in Texas. Wow.
Yeah, I'm sitting in Texas. Yeah, it's 10:02 New Jersey.
10:02 here, but you know what? We have a remarkable job to keep it within an hour. So you covered a lot of information.
Yeah.
And, you know, this is recorded. If it's okay with you, we could send out the recording on our business beat on Friday for folks that missed it, right? Because I'm sure a lot of people probably want to see the slides and hear the discussion. So Alan and Dee, if it's okay with you, we'll send it out in our e-newsletter
Absolutely.
on Friday. But I want to thank everybody for being here. Enjoy the summer, the beautiful weather out there. And at the end of the day, it's still, I guess the guidance is still going to be coming out from IRS, right? So we'll see how this works out. But Alan and Dee and Colleen, thank you so much for the time, sharing your insights, and enjoy the summer.
Yeah.
Thanks, everybody.
Thanks,
Thanks.
everyone.
Thank
Thanks
you.
very much.
Everyone.